So today we're going to talk about how to double your monthly rental income with a 1031 exchange. A 1031 exchange is something that I have a lot of experience doing for my own property as well as help my clients exchange from their property. And I have learned some truth about 1031 exchanges. Today we're going to talk about what is a 1031 exchange, how to double your income with 1031 exchanges, and we're going to use some actual examples here in the Bay Area to show you how the number works. So what is a 1031 exchange? 1031 is actually an internal revenue code. Section 1031, that's how they got the 1031 exchange name from. It basically allows an investor is someone who owns investment property. It could be a single family home, it could be multifamily, it could be commercial property, it could be land, it could be a shopping center, it could be a logistics center. As long as you own a piece of property that you're collecting rent, you're not living in yourself, it's considered an investment property. So a 1031 exchange virtually help you sell your investment property, and if you own the property long enough, most of the investors who own the property for 5 years or more has significant appreciation in the home. If you were just to sell it, there's a capital gain tax you have to pay. Here in California, capital gain tax, it's a range, but it could be as high as 13% on the state level. At the federal level, capital gain tax is either at 15% or 20% depending on your income level. So it's a significant amount of taxes you have to pay on that depreciation upon the sale of an investment property. So most of the time, 1031 exchange is a wonderful strategy to defer that gain to a later time. So what you want to do is that you sell a piece of property, identify your replacement property, and then complete the sale in 180 days to completely defer your capital gain tax. So let's talk about the types of 1031 exchanges. So there is the forward exchange, which means that you sell the property that you sell is called relinquished property. You sell that first, and then you identify your replacement property. Properties that you're buying is called replacement property. You must identify within 45 days of selling your relinquished property, and you must complete the sale within 180 days of selling your relinquished property. To complete the 1031 exchange timeline, you have to stick to the 45 days identification process and 180 days close of escrow process to complete the exchange. The four exchanges, you sell first and then you buy. But occasionally you may see a wonderful property that you really wanted to go for. So you have the means to buy it first and then sell your relinquished property. That is called reverse exchange. Reverse exchange is slightly more complicated. There are a couple of extra steps involved, but it can be done to completely defer the capital gain as well. When you sell a piece of property and you only use a portion of the proceeds to buy replacement property, that is called a partial exchange. For example, if you sell something for $1 million, only buy something for $700,000. The difference between $1 million and $700,000 is called a boot. And a boot is the amount that is subject to capital gain tax. Definitely talk to your CPA about what your boot is like. If you have an actual scenario, I would love to sit down with you and understand whether that's a good strategy for you. But potentially 1031 exchange, if you buy something more than what you sold your property for, you could completely defer the capital gain tax obligation. So let's talk about why 1031 exchange is a good strategy and why do so many wealthy people utilize it as a wealth building tool. Obviously, the number one benefit to a 1031 exchange is the ability to defer your capital gain. Oftentimes, when a property is owned for a couple of decades, there's significant appreciation. We're talking about millions of dollars. And upon the sale of that property, you could be looking at tens, if not thousands, hundreds of thousands in tax obligation on that gain. So being able to defer capital gain is the major benefit to this, many wealthy individuals also use 1031 exchange as a relocation tool. For example, if someone wants to get out of the landlord business, they no longer want to manage their tenants, they could exchange their investment property into maybe a commercial property that has a long-term tenant. For example, you could exchange a multi-unit into a shopping center or a strip mall where the tenants most likely have a long-term lease of 5, 10, 15 years. So significantly less maintenance and less management in that process. You could also exchange your asset into what we call a Delaware statutory trust, and that in itself is another seminar which I will get into a later time. So just know that it's a good tool for asset relocation. Number 3 benefit to a 1031 exchange is that this is a powerful tool to significantly increase your cash flow. Here in the Bay Area, there's tons of demand for single-family home. But if you only have one unit, one single-family home for rent, you are not getting the best rental possible. And later on, we're going to give you some example of how you could leverage the asset to buy multi-units and significantly increase your cash flow. Number 4 benefit for a 1031 exchange is that it could be a really powerful estate planning tool. Upon the passing of a property owner, that capital gain can potentially be completely eliminated when you pass the property on to your heirs. And obviously there are some technicalities we need to get into that, but that is also another attractive feature for 1031 exchange, which is a great estate planning tool. Let's look at some case studies. So this is actually property that I own. I sold my River City single family home a couple years ago for $1.78 million. This single family home was only generating $4,500 a month. What I did is I sold it, I exchanged it into 2 separate properties. One in Hayward that is giving me 2 rentable units, and one in San Jose that's giving me 3 rentable units. I really want to dive into this because I know that many of you are wondering, oh my goodness, when I buy another property, I'm looking at paying higher property tax. I'm looking at paying a higher, I might need to give up my 3% interest mortgage payment and exchange to something currently at 7% interest. Why would that make sense? So let's look at those numbers and to see if this really makes sense to you. So if we look at the relinquished property right here on the left-hand column, the River City single-family home was only generating $4,500. After I deduct my mortgage payment of $3,500 and my utilities, gardeners, and the insurance, which is $750, as well as the property tax at $750, I was actually out every month $500. This River City home was equity rich, but I was cash flow poor in this example. However, when I exchange it into a combine of 2 properties and 5 rentable units, I significantly increased my rental income. And you could see that my replacement property, 1, give me close to $6,000 in rent, and replacement property 2 give me over $10,000 in monthly rent. The caveat is that some of those units are actually midterm renters, which I furnish the units and I rent it for a little higher than market rate because they are 3 months tenants instead of a year tenants. And after I minus all my expenses, as you could see here, I'm still getting a cash flow. That's cash flow is actually positive, and it's if you take into the account of the $500 monthly loss in my relinquished property, I'm actually getting $5,500 and more net increase in monthly income. So this scenario really makes sense to me. Does it make sense to you? You have to decide. So let's look at another example. This is the exchange I helped a client completed recently. He sold his Palo Alto townhouse for $2.56 million and used that money to buy 5 units property in San Jose. In this case, he sold for $2.56 and the replacement property was only worth $2.3. So he has a little bit of a boot between the two numbers in capital gain he had to pay. But let's look at his income. Relinquished property was only generating $7,000 in monthly rent. However, his replacement property is generating north of $1,500 a month in gross income. And keep in mind that some of those units are not paying market rate. So as he replaced those tenants, he is able to adjust the rate up. So there is an upward rental potential on this property, and this property also has a upward potential in appreciating because surrounding areas there's a lot of development. So most likely he not only get a bonus on the cash flow, he also gets a faster appreciation with his exchange. So this is another great example of why 1031 exchange may make sense for people. All in all, 1031 exchange really makes sense if you have a high value but single unit property such as a single family home or a condo or a townhouse, and that if you could exchange it to multi-unit, triplex, fourplex, fiveplex, it could significantly increase your income and give you a significant net cash flow. So this is how 1031 exchange works, and this is a powerful tool of increasing your cash flow. So if this is useful information to you and you want to know more about how 1031 exchange may apply to your scenario, click the link below to attend my upcoming 1031 exchange webinars where I dive into more details and give you more examples and look at some of the nitty-gritty nuances that comes into the 1031 exchange.